What's up, guys? Today we're talking about how to maximize profit and decrease risk for liquidity pools. And by implementing a process that I use, hopefully I could help you with that. Before we begin, here's a quick update on my portfolio. My open positions is sitting at roughly 10.97 ETH of profit. You can see my core positions are doing quite well. Some positions dipped back to negative, but also this position that was down almost 3 Ethereum has turned back around, and I'm only down roughly 0.5 Ethereum right now. So doing pretty good, and my closed position still has like a 7.7 ETH of profit. And I like to measure my profit and loss in Ethereum because I use Ethereum as my quote asset in a lot of these liquidity pools. You guys can use whichever assets you're pairing with and that you're bullish on. And basically, whenever I found that I've been losing money from my liquidity pools, it usually comes down to one of these 5 things. So all 5 are important, and I will go into detail for each of them. I can't guarantee that you're going to be profitable because the market is unpredictable, especially with smaller alts. But I can promise you that if you run through a similar process, it's going to be better than just flying in blindly. So the order of importance is from the bottom up. The first one we're going to look at is asset selection. And if you guys look at this best pool to provide liquidity for diagram that I've made, asset selection is important because you want to bet on assets that are likely to appreciate over time rather than asset that is bleeding out over time. And the APR, in my opinion, is basically secondary because if the assets you're providing liquidity for appreciate in value over time, you're still going to be at a profit and you don't have to worry about the fees covering that depreciation. And if your asset are constantly bleeding out against Ethereum, for example, then you're losing a lot of your Ethereum in the process. Even if you have a high APR, you would be at a loss. And smaller cap altcoins typically fluctuate between outperformance and underperformance. If you guys look back a few videos ago, this Arrow and ETH pool was in profit because the price was trading near my entry, the Arrow to ETH price, but now it has dipped below again. And the fees that I've collected over the last 100 days is not enough to cover this negative divergence loss. Compared to holding, so if I was just to buy and hold Arrow and ETH separately, I'm still up roughly $400 something. So that's all right. But my end goal is to actually have more Ethereum profit if possible. So asset selection is very important. How do we actually go about selecting a good asset? What I've been doing a lot recently is to look at the charts before I actually dive deeper into the token because there's a ton of tokens to choose from. And by looking at the charts first, you could quickly see that if it's bleeding out against Ethereum or even in US dollar terms, how is it performing over the long run and is it likely going to increase in price? And we'll talk a little bit more about technical analysis in the relative strength section that we're going to talk about next. But basically, if the chart looks bullish, it's about to reverse, or it's trading at a good price that you want to enter at, then I'm going to dive deeper into the token. And for the research, I typically just start from CoinMarketCap. For example, if we're researching Ethereum, you can look at the news here and a lot of the data as well as what the project is about, who are the founders, what makes the project unique. And it's going to be different for every token, right? But that's a great way to get an overview of the project without having to spend too much time on it. And if this initial check looks good, then I would probably spend more time on this by diving deeper into the founder, the team, the tokenomics, the token distribution, and cross-check with a lot of the primary sources like their website, their white paper, the founder X account, as well as secondary sources like different analysts or different traders that are posting on X or on YouTube before I form my thesis and what's the strength and what's the weakness of the project. And once I have a core thesis, I would basically also think about the other side, right? What's the point where my thesis is proven wrong? And what's the devil's advocate of like why this token might underperform, as well as some upcoming catalysts. So for example, for Ethereum, my main thesis is that Ethereum is the backbone of DeFi, and it has been that way for quite a while. So if you believe in DeFi, then you should also believe in Ethereum, right? A lot of stablecoins are being launched on Ethereum, and Ethereum has a lot of L2s that get a lot of activity like Arbitrum or Base that also uses Ethereum as a currency. Another part of my core thesis is that people use Ethereum as a currency to trade alts or to pair with alts in liquidity pool. Like the pool you saw on my page, Ethereum is quite important in the digital economy. People use it to pair with liquidity pools, and people trade between Ethereum and altcoins, just like how people use Ethereum as a currency to trade pudgy penguins or other NFTs as well. So that's my core thesis. But the main argument against Ethereum is basically Solana and other high-performing L2s that could basically steal its market share. Chains like Solana, maybe even Sui, and other newer chains like Monad that's coming up. But in my opinion, Ethereum is still a solid bet. It's the most decentralized and secure smart contract network, and I don't think any other chain would replace that anytime soon. So once I selected a good asset and I have a core thesis behind it, it's going to help me basically hold the token for a longer time period and make better decisions. A lot of people basically capitulate when the prices go down because they miss this asset selection part. So the next part we want to look at is the relative strength. Relative strength is basically how is that token trading against other tokens. For example, I could measure Ethereum's performance against Bitcoin, ETH, BTC. You can see Ethereum actually has been bleeding out against Bitcoin for quite some time now, but there is a pretty clear sign of reversal taking place here. We'll see if the moves sustain or not, but in my opinion, Ethereum is still a solid bet if we compare it against Solana. I'm still in this pool at 0.06. I want to stack more Ethereum, but at the same time, it's not the end of the world if I end up with more Solana because I'm bullish on both projects. You can see the outperformance of Solana is beginning to drop because Solana is losing value against Ethereum right now, and we'll see what would happen in the next few weeks. And for the smaller cap altcoins, I want to make sure I'm also looking at the charts. Some people make the mistake of looking only at the US dollar chart. For example, this MOG and ETH pool that I'm in, the US dollar chart looks quite bullish. The momentum is reversing to the upside. It has broken this downtrend here. But the most important chart I actually want to look at is Ethereum. I want to make sure that it has a good chance to outperform Ethereum. And from my own analysis, it does seem like it's going to outperform Ethereum. And again, guys, these videos are not financial advice. It's made for entertainment and informational purposes only. Please do your own research before you invest. But basically, the only reason why I want to invest in smaller cap altcoins is that it's going to outperform Ethereum when the market condition is good or there's a bullish catalyst behind it. And you can see I entered roughly around this part, and now it's trading above my entry, and it has a good chance of retesting the all-time high. So that's comparing against Ethereum, the quote asset. You must do that. And what I also like to do is compare it against category leaders or tokens in the similar niche. For example, I could divide MOG by Dogecoin. You can see MOG actually has been underperforming Dogecoin since last October. But now you can see a clear reversal taking place. And that typically happens again when the market condition is better. Smaller cap tends to outperform larger caps. And if I want to measure to something even closer, I would measure it against Pepe. Since Pepe is the largest meme coin on Ethereum right now, you can see a chart similar to Doge where MOG basically underperformed Pepe for a while. And then now it's beginning to reverse to the upside. And we don't really know the future, right? The trend could continue to the upside for the next few months and then shift again. But right now, the chart looks pretty bullish for me. And as long as it's outpacing Ethereum, I'm happy with betting on this token. So that's mainly the relative strength part. And now we're going to look at sizing. So sizing is like if you went too heavy on a smaller cap token and the token does really badly, then you're going to lose a lot of your capital. Sometimes I see people putting in like 20 to 30% of their capital on a smaller cap altcoin, like that's below 250 million market cap. And then when something bad happens with that smaller cap altcoin, or if it's underperforming Ethereum, then their portfolio is going to be down by a lot. I do have a heavier allocation to Pixel. Pixel is pretty much a micro cap gaming token, but that's because I bought a lot of it for quite cheap. So I don't mind having a higher allocation. But generally, I aim to basically put only 1 to 5% on smaller cap altcoins. That's below like 250 million market cap. And then 5 to 10% into something that's between 250 million to 1 billion market cap. And then roughly 10 to 30% into 1 billion plus. And this is usually like the blue chip pairs. For example, the Sol to Ethereum pair that I'm in currently has like 7.2 Ethereum divided by the asset value right now. So roughly 32% on that, roughly in that 10 to 30% range. Because Ethereum and Solana is quite safe compared to a lot of these smaller cap tokens. And this is talking about the position size, not like the overall portfolio, right? You could build like a higher risk portfolio or a lower risk portfolio. And I go over that in this video here, but you want to make sure that you're limiting the size, especially for smaller cap tokens, because it has a higher chance to lose money, but also a higher chance to generate more return. One thing to keep in mind as well when you're putting funds into a liquidity pool, you're risking this whole amount. You're not just risking whatever token you buy, right? For example, right now, the asset is 0.7 ETH and 7,500 something Arrow in this Arrow to ETH pool. I'm risking these both amount because if Arrow drops in price against Ethereum, then my pool would be fully converted to Arrow. If Arrow, for example, goes to 0, then my entire liquidity pool would go to 0 as well. So that's something to keep in mind. You want to think of the whole pool as one position rather than whatever assets that is inside the pool. So that's the sizing part. For setting ranges, I typically like to look at weekly charts. I see it all the time where people chase a range and then they get wrecked doing so, and I'll explain why in a second. So I'll give you an example. For example, this Bonk and ETH pool. I got a pretty great entry here at this green line, and basically the orange lines are my bottom and top range. If we look back at the historical price action, you can see that I would be expecting at least 6 to 12 months to be in range, and it's quite a wide range liquidity pool. Because I have a wider range, I might have slightly lower fees, but I do have much less apparent loss and much less need to rebalance. One scenario that could happen though is like if Bonk, for example, keeps pumping towards the upside, then it would exit my pool, but I'm fine with that because if it exits on the top side, I'm going to still have a net Ethereum profit. But what this allows you to do is it's going to allow you to accumulate those fees and eventually be in permanent loss pretty easily. So if I was to be in range for more than 1 year, and you can see my APR is roughly 98%, let's just call it 100%. If I'm in range for 1 year, then I'm going to always be beating versus just holding these two tokens separately because my fees would be greater than whatever assets I put in and therefore greater than impermanent loss as well. Impermanent loss cannot be greater than 100%, right? So I can most likely be impermanent loss pretty easily here unless the token pumps or dumps quite wildly, which is not that likely to happen in my opinion, especially for a larger cap altcoin like Bonk. And the reason why I don't want to squeeze the range is because a lot of people try to prioritize the APR. For example, if I move my range to be here, I might be able to capture like the range for a few days or a few weeks, but when Bonk's price drops, my liquidity pool value in Ethereum terms, if I have a very tight range, is going to drop much faster as well because I'm going to be fully converted to Bonk when it exits the bottom side. And then if I choose to rebalance down here, I'm locking in that impermanent loss, basically selling my bonk for more Ethereum when the prices are cheap. And when the price exits the top side again, I'm fully converted to Ethereum again. And then I'm forced to rebalance to chase the range again if I want high fees, basically locking in impermanent loss once again. And I've stalked a lot of wallets in my time from yield farming, and this basically never works, guys. Like maybe 9 out of 10 wallets that I look at with tight ranges typically has like a negative Ethereum profit if they're farming like the crypto to crypto pools like I am. And that one profitable one typically has very little profit that's not even enough to justify the risk. So I personally don't do any of that, and I rarely have to rebalance at all. For example, this Pixel and ETH pool that I'm in, I've been in position for 170 days, so almost like half a year. I didn't have to touch it at all, and I'm sitting at like a 5.8 Ethereum profit, almost a 100% ROI on my investment, and I didn't have to basically touch it at all. So that's the setting ranges part. And then now let's look at the entry and exit. Entry and exit is not as important in my opinion, but it's still quite important because all 5 factors are important, right? In the pyramid, you don't want to ignore it. But basically, if I enter here on Bonk and ETH, I'm going to be sitting at a net profit in terms of my liquidity, not even counting the fees because of divergence loss. Whatever Bonk I buy at this green line is being slowly sold into Ethereum at a price above that. So I'm always getting a better price than what I started out with. And typically you're starting off with like the quote asset, right? For example, Ethereum in this case, when you're making new investments. And when I see a pool like this, I could choose to exit at any time with a net profit. If you zoom into the P&L here, you can see here the divergence loss is basically 0.87 Ethereum of profit and roughly 0.55 ETH of fees, which adds to this total profit number. But even if I didn't get any fees, I would still be in this 0.87 ETH of profit, and I could rotate this position into any other pool at any time. So that's the entry. You want to try to get a good entry. And personally, I find like trendline entries to be a little bit unreliable. So now I mainly focus on like horizontal areas of support. You could see I entered at an area of support, and then I can choose to exit at an area of resistance if I want to. For example, this was actually an area of resistance that I could have exited, but I'm bullish on this project long term, so I'm not going to exit. I'm going to keep a good entry here, and I could basically keep like selling my fees for a profit, knowing that my original liquidity is sitting in nice profits still. And if it dips below my entry, I could choose to reinvest some of those fees to basically drag down my entry. So that's the way I run most of my pools. When it's trading above my entry, I could choose to take profit at a zone of resistance, or I could just keep the liquidity in the pool because it's earning really nice fees, right? And just keep selling the fees when I'm in the pool to de-risk. So that's pretty much it for this video, guys. If you run through this whole process, I believe it's going to do better than if you just pick 1 or 2 to do, right? And then you miss these other core factors. And every position that I've lost money on typically comes back to these 5 things. So I hope that video helped you guys out. If you want to learn more about liquidity pool yield farming, how to do it more safely and more consistently, be sure to check out other videos on my channel. Thank you once again for watching. I'll catch you guys next time.